Stop everything. It's Saturday, January 18th, 2026, and while you were busy watching silver hit new highs, while you were tracking the dollar's decline, while the entire financial world was obsessed with China's aggressive selling of US Treasury bonds, something far more significant just happened that almost nobody is talking about. And what I'm about to reveal to you in the next several minutes is going to fundamentally change how you understand what's really happening in the global financial system right now. For the last 2 years, every financial analyst, every mainstream media outlet, every geopolitical commentator has been focused on one narrative. China is dumping US debt. China is the enemy. China is trying to destabilize the dollar. And yes, that's true. China has been aggressively liquidating US Treasury securities, but while everyone was staring at Beijing, while all the cameras were pointed at the obvious threat, a second player, perhaps an even more important player, quietly made a move that signals something far more dangerous for the future of the US dollar and the entire Western financial system. I'm talking about India, and what India just did is not just significant, it's a seismic shift that Wall Street is desperately trying to ignore because it completely destroys the narrative that it's just China, it's just politics, everything else is fine. India isn't supposed to be the problem. India is supposed to be our friend. India is supposed to be the counterweight to China in Asia. India is supposed to be the reliable buyer, the stable partner, the country that would never abandon the dollar system. But the data that just came out tells a completely different story. Between October 2024 and October 2025, just 12 months, India slashed its holdings of US Treasury securities by nearly 21%. Let that number sink in for a moment. 21%. In absolute terms, the Reserve Bank of India liquidated approximately $50.7 billion of US debt. Their total holdings collapsed from a peak of $241.4 billion down to $190.7 billion. This is not a minor adjustment. This is not seasonal rebalancing. This is not currency intervention. This is the first sustained annual decline in 4 years, and it's happening right now in real time while most people aren't even paying attention. Now, here's where this gets absolutely wild. And this is the part that should make every economist, every central banker, every financial analyst stop and question everything they think they know about how the system works. Right now, today, US Treasury yields are sitting between 4.0% and 4.8%. Think about what that means for a moment. For a central bank, for a sovereign wealth fund, for any institutional money manager, a 4.5% yield on the world's supposedly safest asset is incredibly attractive. Historically, when yields are this high, foreign central banks pile into US bonds. They buy the yield. They lock in the return. It's the easiest trade in the world. Park your money in US Treasuries. Earn 4.5% risk-free. Sleep well at night. India is doing the exact opposite. They're selling. They're walking away from a guaranteed 4.5% return in the world's reserve currency. They're voluntarily exiting a high-yielding liquid asset. Why would anyone do that? Why would a rational central bank turn down a 4.5% risk-free return? There's only one answer, because they don't believe it's risk-free anymore. When a central bank sells a high-yielding asset, they're not making a statement about return. They're making a statement about risk. They're telling you that the return is no longer high enough to compensate for the danger of holding that asset. Let me be very clear about what this means. India is telling us that US Treasury bonds, the bedrock of the global financial system, the asset that every economics textbook calls risk-free, are no longer safe. And they're putting their money where their mouth is. They're voting with their feet. They're getting out. Now, before you think India is selling because they're desperate, because they're broke, because they need cash to defend a collapsing currency, let me stop you right there. That's not what's happening. India's total foreign exchange reserves are sitting near record highs of $686 billion. They are absolutely swimming in liquidity. The rupee has been relatively stable compared to other emerging market currencies. Their economy is growing at 7 to 8% per year. They're the fastest growing major economy on the planet. So this selling is not driven by necessity. It's driven by choice. It's strategic, it's calculated, and that makes it far more dangerous. India isn't selling because they have to. They're selling because they want to. They're selling because they've made a conscious decision to reduce their exposure to the US dollar system and the potential weaponization of US financial infrastructure. And when I show you exactly what they did with that $50 billion, you're going to understand why this is one of the most important financial stories of 2025 that almost nobody covered. Let me take you back to February 2022 for a moment because that's when everything changed. That's the moment when the rules of the game were rewritten and every central bank on earth took notice. In February 2022, after Russia invaded Ukraine, the United States and European Union made a decision that will be studied by historians for the next century. They froze $300 billion of Russia's sovereign assets. Think about what that means. Russia had accumulated foreign exchange reserves, dollars, euros, bonds, over decades. They held this wealth in Western banks and Western financial institutions. And overnight, with the stroke of a pen, that wealth became inaccessible. It was frozen, it was weaponized, it was turned into a bargaining chip. Now, If you're the Reserve Bank of India sitting in Mumbai watching this happen, what do you think goes through your mind? India maintains a fiercely independent foreign policy. They buy oil from Russia, massive quantities of it. They buy weapons from France. They buy technology from the United States. They're playing all sides because that's what smart geopolitical players do in a multipolar world. But when they watched $300 billion of Russian assets get frozen, they realized something terrifying. Holding $240 billion in US Treasury bonds isn't a safety net. It's a kill switch. If tomorrow the United States decides that India needs to pick a side, maybe in a conflict over Taiwan, maybe in a dispute over Iran, maybe over some other geopolitical flashpoint, and India refuses to comply with US sanctions, that $240 billion could be frozen with a single order from the US Treasury Department. All that wealth, all those reserves that India accumulated through decades of hard work and trade surpluses could become numbers on a screen that they can't access. And unlike Russia, which was somewhat prepared for isolation, India's economy is deeply integrated with the global system. A freeze like that would be catastrophic. So what's India's answer? Get out now, quietly, methodically. Reduce the exposure before the trap springs. Unlike China, which is dumping debt potentially to fund a war chest for a kinetic conflict, India is dumping debt to build sovereignty. They want to ensure that their national savings are immune to the whims of Western foreign policy. They want to make sure that no matter what happens geopolitically, their wealth is protected. And this represents a massive structural problem for the US Treasury's funding model. For the last 30 years, the entire system has operated on an assumption. As developing nations get richer, they will automatically buy more US debt. It was the natural bid. It was the foundation of dollar hegemony. We assumed that India's growth, 7%, 8% annual GDP growth, would subsidize America's deficits. That assumption is now dead. India is growing faster than ever, but their purchases of US debt have not just slowed, they've reversed. They're selling. This creates a structural hole in demand that someone has to fill. If the fastest growing economy on Earth isn't buying US debt and the second largest economy, China, is actively selling US debt, who's left? The answer is what I call the hidden buyers: hedge funds, leveraged speculators, proxy accounts in tax havens like the Cayman Islands, and ultimately the Federal Reserve itself through various backdoor mechanisms. This makes the entire system more fragile, more leveraged, and more dependent on financial engineering rather than real demand. Now here's where the story gets even more fascinating, and this is the part that should make your jaw drop. That $50 billion didn't just disappear. India didn't sell US Treasuries and stuff the cash under a mattress. They transformed it, they converted it, they swapped one asset for another, and the asset they chose tells you everything you need to know about what they think is coming. They bought gold. But more importantly, and this is absolutely critical, they moved it. To understand why this matters, you need to understand India's traumatic history with gold. In 1991, India faced a severe balance of payments crisis. The country was literally days away from defaulting on its external debt. It was a national emergency. And to secure an emergency loan from the Bank of England and the Bank of Japan, the Indian government had to physically airlift 67 tons of its national gold reserves to London and Tokyo as collateral. Imagine that moment. Imagine being a proud nation with thousands of years of history, and you have to pawn your gold, your national treasure, to foreign banks just to keep your economy alive. It was a moment of profound national humiliation that seared itself into the collective memory of Indian policymakers. For the next 30 years, even as India recovered and became an economic powerhouse, a massive portion of its gold reserves remained in London. They were sitting in the vaults of the Bank of England, and the official reason was convenience. It's easier to trade gold when it's in London. It's easier to lease. It's easier to use in the Western financial system. It was financial gold. Gold that existed on a ledger, gold that could be moved with keystrokes, gold that was integrated into the global financial plumbing. But in 2024 and 2025, the Reserve Bank of India initiated something extraordinary. They decided to bring the gold home. And not just a little bit. We're talking about one of the largest physical transfers of gold by a major central bank in modern history. According to recent disclosures and analysis from the World Gold Council, India repatriated approximately 274 tons of gold between March 2023 and September 2025. Just think about the logistics of that for a moment. We're talking about physically moving hundreds of tons of metal, one of the most valuable substances on Earth, from London to Mumbai. In the first half of fiscal year 2025 alone, they moved 64 tons. This required military-grade security, specialized transport aircraft, coordination between governments, insurance, logistics, planning. This is not something you do on a whim. This is not something you do because it's convenient. You do this because you fundamentally don't trust the current arrangement anymore. As of late 2025, over 65% of India's gold reserves are now held domestically, within the sovereign borders of India, in high-security vaults in Mumbai and Nagpur. So why does this matter? Why go through all this expense, all this risk, all this logistical complexity? Because gold sitting in the Bank of England vaults is fundamentally different from gold sitting in Mumbai vaults. Gold in London is a financial asset. It's a ledger entry. It's subject to UK law. It can be leased out to bullion banks. It can be rehypothecated, used as collateral for multiple transactions simultaneously. And most importantly, it can be frozen. If the UK government, acting in concert with the United States, decides to sanction India for any reason, that gold in the Bank of England becomes inaccessible. It becomes a number on a screen that you cannot touch. Gold in Mumbai is completely different. It's a sovereign asset under the direct physical control of the Indian military and the Central Industrial Security Force. It cannot be frozen by Western sanctions. It cannot be blocked by SWIFT. It cannot be leveraged by Western banks. It's yours, completely, unconditionally. By moving the metal, India is removing the counterparty risk of the West. They're effectively saying, we do not trust the Bank of England to hold our wealth anymore. We don't trust the rules-based international order to protect our property rights. We're taking physical possession because possession is the only thing that matters when the system breaks down. And while they're moving the old gold home, they're aggressively buying new gold. The Reserve Bank of India's total gold reserves have surged to approximately 880 tons. They were the second largest net buyer of gold in the world last year, behind only China. Gold now makes up nearly 14–15% of India's total foreign exchange reserves, up from just 7.4% a few years ago. The value of this gold hoard has crossed $100 billion for the first time in Indian history. Now let's look at the complete trade, because this is where the strategy becomes crystal clear. They sold $50 billion in U.S. paper treasuries. They built a $100 billion fortress of gold. This is a textbook collateral swap. They're swapping unsecured liability, U.S. debt, which relies on the U.S. government's ability and willingness to pay, for secured collateral, gold, which relies on physics. Gold doesn't depend on anyone's promise. Gold doesn't require trust in a government or a central bank or an institution. Gold is gold. It's elemental. It's eternal. It has been money for 5,000 years, and it will be money for another 5,000 years. This is the behavior of a nation that expects the global financial system to fracture. A central bank does not go through the massive expense and security risk of repatriating hundreds of tons of gold if they believe the world is heading toward greater integration, cooperation, and peace. They do it when they fear fragmentation, conflict, and the breakdown of trust. India is preparing for a scenario where the paper claims of the global financial system might not be honored. They're securing the physical foundation of their monetary sovereignty. And here's what makes this even more significant. India is supposed to be a strategic partner of the West. They're part of the Quad, the security alliance with the US, Japan, and Australia designed to counter China. They're a democracy. They speak English. They have deep cultural and economic ties with the Western world. If India, our friend, our ally, our partner, is quietly exiting the dollar system and repatriating gold, what does that tell you about what they really think is coming? When your business partner starts taking his money out of your bank and hiding it in a vault you can't access, the relationship has fundamentally changed. The trust is gone, and without trust, the entire architecture of the modern financial system begins to crumble. Let me explain the deeper strategic logic behind why this is happening right now in 2025, because the timing is not accidental. The Reserve Bank of India has explicitly stated in its official reports that this diversification is driven by geopolitical risks and the need to insulate the economy from external influences. In the diplomatic language of central banking, this is basically shouting. Translation, they're preparing for a post-dollar world. India, under its current leadership, envisions itself as the leader of the global South, the voice of the developing world. They're positioning themselves as the third pole in a multipolar world, distinct from the Western Bloc led by the United States and distinct from the Eastern Bloc led by China. To play this role successfully, India needs to be able to trade with everyone. They need to buy oil from Russia, which they do in massive quantities at discounted prices. They need to attract investment from the UAE and Saudi Arabia. They need to maintain technology partnerships with Silicon Valley. They need to buy fighter jets from France and maintain their massive arsenal of Russian weapon systems. To maintain this strategic autonomy, they cannot be held hostage by US dollar payment rails. Here's the mechanics of the trap they're trying to avoid. If the United States decides to place secondary sanctions on entities trading with Russia, and India is holding $200 billion in US Treasuries and settling all its trade in dollars, India becomes vulnerable. The US Treasury Department can effectively shut down the Indian economy by blocking SWIFT access or freezing dollar-denominated assets. Game over. But by swapping treasuries for gold and holding that gold domestically on Indian soil, India becomes sanction-proof. They can settle trade in rupees, they can settle in dirhams, they can settle in yuan, they can even settle in gold if necessary, bypassing the US banking system entirely. Gold allows them to settle balance of payments deficits with any nation regardless of the political climate. It's the ultimate neutral reserve asset. No country controls it, no sanctions can freeze it, no financial system can block it. We're seeing this strategy play out in real time through what's called the internationalization of the rupee. The Reserve Bank of India has established mechanisms to allow international trade to be settled in INR, Indian rupees. They've opened what are called Vostro accounts for over 20 countries, including Russia, Sri Lanka, and nations in the Persian Gulf. These accounts allow India to pay for imports in rupees, and the partner nation can then use those rupees to either invest in India or buy Indian goods. Now, the volumes are currently small compared to the massive tide of dollar transactions that still dominate global trade, but the trend is undeniable and accelerating. India is methodically building parallel plumbing for international trade, a system that doesn't pass through New York, doesn't require approval from the U.S. Treasury's Office of Foreign Assets Control, doesn't depend on SWIFT codes or dollar-clearing banks. That $50 billion exit from U.S. Treasuries is the funding mechanism for this independence. They're liquidating the asset of the old hegemon to fund the architecture of their own sovereignty. They're using the proceeds of the old system, U.S. debt, to build the infrastructure of the new system, gold-backed monetary independence. This represents a tectonic structural shift in global finance. For 30 years, the model was beautifully simple. Emerging markets export goods to the United States. They earn dollars. They recycle those dollars back into U.S. Treasury bonds to keep their currencies cheap and their reserves safe. This created an automatic bid for U.S. debt. America could run massive deficits because the rest of the world would automatically finance them. It was a perpetual motion machine. That model is breaking. Now, as India grows, and remember, they're growing at 7 to 8% per year, adding $1 trillion to their economy every few years, they're not just automatically buying more treasuries. Instead, they're buying gold. They're buying infrastructure. They're investing in their own digital payment infrastructure like UPI, which is one of the most advanced payment systems in the world. They're building ports, highways, solar farms, and semiconductor fabs. They're investing in their own future rather than financing America's present. This removes a massive pillar of support for the U.S. deficit. If the developing world stops recycling its trade surpluses into U.S. debt, the United States must find new buyers. And as I said earlier, the only buyers left are increasingly leveraged hedge funds, proxy accounts, and ultimately money printing by the Federal Reserve. The exit of real money investors like India forces the U.S. system to become more fragile, more leveraged, and more dependent on financial engineering. The whole structure becomes a house of cards. India knows this. They understand the mathematics of what's happening. They're getting out before the inevitable dilution destroys the value of their reserves. They're engaging in what I would call a non-aligned hedge, betting that the future belongs to those who hold hard assets, physical commodities, and real productive capacity, not to those who hold the debt of fading empires with unpayable obligations. Now let me tie all of this together and show you what it means for you, because this isn't just an academic discussion about central bank reserve management. This is about your money, your savings, your future. When central banks, the biggest, most informed, most conservative players in the global financial system, start making moves like this, you need to pay attention. These institutions have access to data you'll never see. They have relationships with other central banks, with governments, with intelligence services. They understand the fragility of the system better than any retail investor or financial advisor ever could. And what are they doing? They're selling paper promises, bonds, IOUs, treasury securities, and they're buying physical hard assets, gold, silver, commodities. They're moving those assets into their direct physical possession, removing counterparty risk. They're building parallel financial systems that don't depend on the dollar. These are not the actions of institutions that believe the current system is stable and sustainable. These are the actions of institutions preparing for disruption, fragmentation, and potentially breakdown. So what should you do? How do you protect yourself when the central banks are quietly heading for the exits? Let me give you a framework, a protocol for navigating what's coming. First principle, follow the whales. The first rule of macro investing is simple. Watch the biggest, smartest players and do what they're doing. If the Reserve Bank of India, with all its data, intelligence, expertise, and conservative risk management culture, is selling treasuries to buy gold, you should pay very close attention. Central banks are the ultimate insiders. They see the flow of funds before anyone else. They understand the system's vulnerabilities better than anyone. When they buy gold, they're not speculating that the price will go up next week. They're not trading a chart pattern. They're not trying to make a quick profit. They're buying insurance. Insurance against currency debasement, against sanctions, against the breakdown of international cooperation, against the fracturing of the global monetary system. You need that same insurance. You cannot afford to have 100% of your wealth invested in the paper system, stocks, bonds, fiat currency sitting in bank accounts, when the architects of that system are actively diversifying out of it. Allocate a meaningful portion of your portfolio to physical precious metals. I'm not saying go all in, I'm not saying sell everything and buy gold bars, but if central banks are moving from 7% to 15% gold allocation, maybe you should be thinking about having at least 5 to 10% of your investable assets in physical precious metals. If you're in India, look at sovereign gold bonds if they're available. They offer interest payments plus the capital appreciation of gold. If you're elsewhere, consider allocated physical gold from reputable dealers, or gold ETFs that are fully backed by physical metal stored in segregated vaults. The key point is this: do not be the last person holding paper liabilities of a bankrupt system when the sovereigns have already moved to metal. Second principle, diversify your currency exposure. What India is doing confirms that the dollar's dominance is fraying. It's not going to collapse overnight. The dollar isn't going to zero tomorrow. But its exclusive role as the global store of value is diminishing. Its utility is declining. Its risks are increasing. India is preparing for a world of currency fragmentation, a world where you need rupees to trade with India, yuan to trade with China, euros for Europe, and dollars for what's left of the dollar zone. You should prepare for this reality too. Do not hold 100% of your wealth in a single currency, especially if that currency is being printed at an accelerating rate to finance unpayable debts. If you have the means, diversify internationally. Open accounts in multiple jurisdictions. Hold currencies that are backed by commodities or strong productive economies. But more fundamentally, own real assets that aren't denominated in any particular currency. Productive farmland, commercial real estate in growing markets, businesses that produce essential goods and services, commodity-producing assets. Why? Because inflation is the mechanism by which the United States will attempt to monetize the debt that India and China are refusing to buy. If foreign central banks won't buy U.S. Treasuries, the Federal Reserve has to step in and buy them, either directly or through various proxy mechanisms. When the Fed buys Treasuries, it creates new dollars out of thin air. That's inflation, that's currency debasement, that's the slow, invisible confiscation of your purchasing power. A farm can't be debased by a printing press. A gold bar can't be inflated away. A barrel of oil maintains its real value. But a Treasury bond? A bank deposit? Cash sitting in your checking account? All of that loses purchasing power every single day that the money supply expands faster than real economic growth. Third principle, watch for the acceleration signal. The movement of gold from London to Mumbai is not just a financial transaction, it's a physical signal, a flash of lightning on the horizon telling you that a storm is coming. It means that trust, the invisible glue that holds the financial system together, is eroding. You need to watch for other countries doing the same thing. Are there rumors of Saudi Arabia repatriating its reserves? Is Germany accelerating its gold repatriation program? Are nations in Africa, Latin America, or Southeast Asia demanding their metal back from Western vaults? If this trend accelerates, if more countries join India in bringing gold home, the quiet exit becomes a stampede. If every nation suddenly demands physical delivery of their gold from London and New York simultaneously, we're going to discover something shocking. There isn't enough metal to go around. The paper gold market, where the same physical ounce is claimed by multiple parties through complex lease and derivative arrangements, will collapse. The price of physical metal will decouple from the paper price and skyrocket. That's the moment the system breaks. That's the moment when financial claims become meaningless and only physical possession matters. And that's the moment you want to already have your position secured, because by the time that moment arrives, you won't be able to get metal at any reasonable price. The premiums will be insane. The dealers will be sold out. The mints will have years-long waiting lists. The time to prepare for a crisis is before the crisis, not during it. Let me bring this full circle and give you the big picture, because what we're witnessing is nothing less than the early stages of a historic monetary transition. For the last 80 years, since the Bretton Woods Conference in 1944, the world has operated under a dollar-centric monetary system. The dollar became the world's reserve currency. The U.S. Treasury bond became the world's safe asset. Every central bank held dollars. Every commodity was priced in dollars. Every major transaction cleared through New York. This system worked for a long time because the United States was the dominant economic power, the dominant military power, and the most trusted party in the global system. But that trust has been progressively eroding. The 2008 financial crisis showed that U.S. financial institutions weren't as sound as everyone assumed. The massive money printing after 2008, and especially after 2020, showed that the dollar's purchasing power wasn't stable. The freezing of Russian assets in 2022 showed that the dollar system could be weaponized against anyone who didn't comply with U.S. foreign policy. Each of these events chipped away at trust. And now we're reaching a tipping point where major players are looking for alternatives. China is building the Belt and Road Initiative to create yuan-denominated trade corridors. Russia is demanding payment for energy in rubles or gold. The BRICS nations are developing alternative payment systems. Saudi Arabia is signing oil deals in currencies other than dollars, and India, democratic, Western-aligned, English-speaking India, is quietly exiting U.S. Treasuries and moving gold home. These are the signs of a system in transition. The old order is dying. It's not dead yet. It will probably take years or even decades to fully collapse, but it's dying. And what comes next is uncertain. Will it be a multipolar currency system with several regional reserve currencies? Will it be a return to some form of commodity-backed money? Will it be a completely new digital monetary architecture? Nobody knows for sure. But what we do know is this. During these transitions, the people who hold paper promises get destroyed, and the people who hold physical assets survive and often thrive. This has happened over and over throughout monetary history. When the Roman denarius was debased, those holding physical gold were protected. When the German mark hyperinflated in the 1920s, those holding real assets survived. When currencies collapsed in Latin America, Asia, and Africa over the last century, gold holders were protected. The pattern is always the same. First, the authorities promise that everything is fine. Then they print more money to solve problems. Then inflation accelerates. Then trust breaks down. Then people rush to convert paper into things. And by the time the masses figure out what's happening, the opportunity to protect yourself at reasonable prices is gone. Right now, we're somewhere in the middle of that process. Central banks like India's are already moving, sophisticated investors are already diversifying, but the general public is still mostly asleep, still mostly trusting that the system will continue to work the way it always has. That's your opportunity. That's your window. You still have time to position yourself like a central bank, to follow their playbook, to diversify into hard assets, to reduce your dependence on paper promises. India just unwound $50.7 billion in U.S. Treasuries. They didn't do it to make a profit on a trade. They didn't do it because they needed emergency cash. They did it for survival. They did it to build a gold-backed firewall against the volatility, instability, and potential weaponization of the Western financial system. They're preparing for a world where the old rules no longer apply, where dollar dominance is no longer guaranteed, where only physical possession provides true security. The message is clear. The East is leaving the building, and they're taking their gold with them. The smart money is diversifying, the whales are moving, the central banks are repositioning. The only question is, are you paying attention? Are you going to follow the smart money, or are you going to be the last person holding the bag when the music stops? If you found this analysis valuable, if it opened your eyes to what's really happening behind the headlines, do me a favor. Hit that like button so this information reaches more people who need to hear it. Subscribe to this channel because I'm going to keep tracking these macro trends and breaking down what they mean for your money. And drop a comment below telling me, are you already positioning in physical metals, or are you still 100% in the paper system? I read every comment, and your perspective helps this community learn together. The protocol is simple. Follow the whales, diversify your exposure, watch for acceleration signals, and position yourself in real assets before the transition becomes obvious to everyone. The quiet exit has begun. The question is whether you'll exit quietly with the smart money, or whether you'll be caught in the stampede when everyone else finally figures out what's happening. The choice is yours, but don't say you weren't warned.